Mr. Chairman, I'd like to thank our panel as well for being here. Dr. Kupiak is appreciating your words when you're talking about uncertainty in the marketplace and a need for clarity. But I think there's a lot of concern when we're talking about transparency and accountability as we continue to see the federal government, through a variety of different organizations, continue to extend its footprint in terms of regulatory authority. And I think we can make a very credible argument that if we are not having inflation, we are having taxation via regulation, because ultimately these costs are being passed on to the American consumer, driving up costs. But what I'd like to be able to maybe focus on and get your comments on is we have now a lot of our entities that are looking to be able to get out from under the designation of being a SIFI. We have General Electric right now trying to be able to sell off some of its assets simply to get out from under the designation and the onerous provisions that are going to be inhibiting their ability and increasing costs for consumers, by the way. Would you like to maybe speak a little bit about that uncertainty, that lack of clarity that we are seeing out of that designation process? Is it, to quote your words from just a moment ago, is it just a great mystery, a guessing game that we're having to play with?
The designation as systemically important under 165 of the Dodd-Frank Act causes a lot of new rules and regulations. One of the most onerous ones is the CCAR stress test, the big stress test that the Federal Reserve Board does annually. And one of the reasons is because it's really a guessing game. There is no good model which you can put in a macroeconomic scenario and accurately forecast how a financial institution is going to perform. That is a fictional story. The people in charge love it because it played well in 2009 with the stress test. But in the fact of the matter is, there isn't a stress test anywhere in the globe that ever detected a crisis before it happened, or even designated the firms that got into trouble when the crisis happened. There's just so much uncertainty, you can't model it. And this gives rise to lots of problems when firms go in every year. They spend millions of dollars, hundreds of millions of dollars, trying to model it, and their models now are more aimed at modeling what they think, how they think the Fed is going to model it, rather than what actually happens. And these are totally fictional, hypothetical scenarios in which their management is forced to put huge effort and huge money on modeling a fictional event that never happens. And if they get a bad grade on that story by the Fed, they can't pay a dividend, they can't buy back a stock, they might not be able to merge with anybody or open up another line of business. So these are very judgmental. This is a very judgmental regulatory approach that really isn't based in science at all, and I think it's very destructive, I think.
So we're modeling for the modeling without an instruction manual.
Yes, and we've built a huge industry to support the modeling of the modeling.
I believe you're right on that. We had Secretary Lew just before this committee and refused on his part to be able to answer and give any kind of real information in terms of what information is going to be required for that designation for companies to actually to be able to respond to. Would like to be able to follow up maybe with Dr. Calabria in regards to some of your comments in regards to just the composition under the Federal Reserve Act for the designation on the board. Why is that diversity important?
Well, because I think it's important to keep in mind that different parts of the country move at different paces. Texas is not California, Colorado's not Alabama, and so I do think if you want a monetary policy that essentially tries to do the best for everybody in the country, you need to have that diversity in the board. And I'll certainly say as an aside, the Feds just simply follow the law. I mean, the law says no more than 2 members from one district. It's actually pretty clear. And the fact that that has been flaunted regularly, to me, respect for the law has to start with the regulators, or why would the regulated entities think that anything goes themselves? But again, the important part is that you can get a variety of viewpoints, so it's not simply Washington or New York that dominates the policymaking.
And just final question, and if anyone would like to be able to speak to this, is a real concern. I think our first obligation is to make sure that the economy of the United States is sound, that our economy is working for our people. And when I hear it's a mystery in regards to the FSOC and its response to the FSB. How concerned should we really be that we're having our policies driven by foreign entities as opposed to charting our own course?
You're addressing that generally? I mean,
Yes, sir.
Well, so let me actually just, one thing that I would add to this. It is important to discuss and collaborate with other entities, what's going on, with other governments, with other regulatory agencies. The Financial Stability Board began as something called the Financial Stability Forum. And it had, I served on that. It basically had an advantage. You had representatives from the treasuries, the finance ministers, the central banks, and from some regulatory agency, in our case, the SEC. So those discussions were quite fruitful. I think there is a concern if actually policy is being made and that commits to the United States in some way. So collaboration, if you like, or essentially discussion of what's going on in these groups with the Congress, I think is quite important. But the fact that they exist, I think, is not the problem.
The gentleman's time has expired. The chair now recognizes